So our topic today is security pricing. How much are we willing to pay today for future income? So I'll go through some examples of basic securities, and then we'll get to a more complicated issue of how stock prices are determined and what causes for security prices to fluctuate. So let's start with what is referred to as risk-free or the lowest risk in the market, the US Treasuries. Now, since the US is considered to be, the lowest term, US Treasury is considered to be risk-free, this is our starting point. Now, every day we have a daily Treasury auction, and at this auction, US Treasury issues and sells 1 month, 2 months, 3 months, 6 months, 5 years, 30 years, and so on and so forth, different maturity US Treasuries to public, to individuals like you and I, and to financial institutions. Now, on 2nd of January of 2019, the 1 month US Treasury sold at 2.40% yield per annum. And same yield was paid for 2 months, very similar to 3 months. And then as you can see, 30-year Treasury was sold at 2.97%. Now, just to give you a point of reference, let's look at, say, year 2000. And if you look at the yields here, we didn't have 1 month or 2 months, and 3 months was 5.48%, and 30-year was 6.61%. Let's take a look at, say, 2006, right before the crisis, and you'll see that then we didn't have 30 years. 1 month sold for 4.05%, and 20 years sold for 4.62%. So the yield curve refers to the pricing or the yield having a curvature of different yields across different maturity dates. Now, ultimately, what you would expect is to earn a little bit more for locking your money into a 20-year commitment. So you would expect to earn, I personally would expect to earn substantially more to give up my money and make a commitment of an investment for 20 years or maybe even 30 years. So looking at 2019, the yield curve is almost flat, and this is concerning. In fact, if you look at the current levels in June, you will see that 230 is the current 1 month yield, and 257 is the 30-year. In fact, look at this. This is 1.85%, 1.82%, 5, 10 years, and so on and so forth. This is a significant issue. So let's talk about the pricing of these treasuries, right? Let's look at a bond, a high yield bond, like this Argentinian Eurobond that was issued in 2015, and then now it has a maturity of 2020. So this will mature in October the 8th, 2020. It has a fixed coupon, and it has a price of $90.372. This makes it so that our net yield is 7.8% per annum. This is investing now and getting our money back in October. So think of it like this. We are going to receive $100 in October the 8th. How much are we willing to pay today for this investment? Now, this currently has no coupon, so the only thing that we really are going to receive is the $100 face on the expiration date, October 2020. We are going to pay $90 and change for that $100 that we're going to receive in October 8th, 2020. Now, if you look at the next one, this is 2021, April 22nd, and this has a coupon that we're going to receive more than likely in 6 months or every 6 months. And currently we're willing to pay $84 for this. And our yield to maturity by paying $84 is 16 and some change percent. Now, going back to the daily treasuries, very much like that Argentinian bond, these treasuries also sell for what you're willing to pay today. That's the current price. Now, you're going to receive $1,000 or $10,000, whatever the face value is on these treasuries, on their maturity date. By paying a discount as of today, you are earning a certain level of yield. So for this Argentinian bond that matures in 2020, we will receive $100 and we are willing to pay $90 for it. Now, in this bond, no yield is written on the bond. However, as you pay $90 for it today and receive $100 in October of 2020, your net yield will be 7.8%. So you determine what your yield will be by paying for this bond, whatever you're paying today. So if you were to pay $80, you're still going to receive $100 on the face value on the maturity date, which would make your yield significantly higher than 7.8%. So think of it like this. Let's open up a spreadsheet and go through with that example. So if we are going to receive $100, a very simple example. Let's say that this is the future value and it's $100. Now, how much are we willing to pay for it today? Let's call it current price. Let's say we're going to pay $90 for this. And let's not complicate it by giving specific dates, just say 1 year per annum. Now, how much are we making? Our net return, right, is your future value minus what you're paying. That's $10. Perhaps we should call this net income. The net return then would be the $10 that you are going to receive as your income divided by your current price or your investment, right? Which makes this 11%. Now, if you pay for this $80 today, now your investment is now $80 instead of the $90. You paid less. Your future value does not change. That's how much the bond is going to pay you a year from now. The net income, however, is now higher simply because you're paying $80 for a $100 future value. Now, based on that net income of $20 and based on that investment of current price of $80, your net return now is 25. Perhaps we should write them both. So just to see. Now, if we pay $80 today, that's how much. So let's say that we're going to pay $50. Now notice, the future value does not change. You are going to receive $100. You are paying $50 for it today instead of 80 or a 90, which means that your net income then will be 100 minus your investment, which is $50, which means that you're going to have a net return of 100%. Let's say you're paying $10. So if you pay $10, now notice you're paying a very small amount for a $100 future value, which means that your net income will be $90. You're paying $10 to receive a $100 future value. Therefore, your net income will be substantial compared to your current price. you're paying $10 to receive a $100 future value, which gives you a net income of $90, which is 900% or ninefold of your original income or original investment. Now, let's take a look. In this specific example for this Argentinian bond, we are paying $90 and we're going to receive $100 on October 2020, and our yield to maturity based on this is 7.8%. We are paying $84 right here, and our net yield to maturity is 16%. Now look at this Jamaican bond. The Jamaican bond now has a coupon, so we actually have an interim payment. This is a maturity of 2025, and we are actually paying $126. We are paying more than the face value. So this is referred to as a premium bond. This is referred to as a discount bond. Now on this premium bond of 126, by paying that much and receiving 9.25% of a coupon and receiving a $100 face value on October 17, 2025, we end up making 4.48%. Now, this is very important. If we're talking about a stock, let's pull up a stock. Let's say that we are going to talk about which company? Say Apple. Right. So Apple now sells for $190 and $15. So that's our current price, 190.15. Now, we don't know the future value, so that's what complicates it for stocks. Now, however, we actually have a PE ratio of 16. Now, remember last week we talked about what PE ratio is. So if the PE ratio is 16, then the EP ratio is 1/16, which makes it a percentage of 6.25%. So basically what we're talking about is by paying $190.15, we are going to end up making 6.25% of a return on Apple. Now, the earnings per share is your net income. That's $11.89. So we can actually calculate a future value on this, but notice on the bonds, what you're paying right here is what you are paying. So this is your determination of how much this bond is worth. Now, if you don't think that this is a fair value, then you won't pay that. And if you don't pay that, the price of that bond will go down. As the price goes down, yield will go up. Now think about it. If you actually are not willing to pay for it, and if other investors are not willing to pay for it, this amount, then there are no buyers of this bond, and therefore the price is going to go down. As the price goes down, the net return, or commonly referred to as net yield, will basically climb up. So much so that in the case of Argentina, you notice that we're paying 16%, or we're earning a yield of 16%, 12%, 11%, and 10%, and so on and so forth, for a simple bond. So if you think that that price is fair, and if you start paying that, in fact, that you are willing to pay more for that, then the price is going to go up. Similarly for the stock, if the price goes up, your net income is unexpected. So let's take a look at Apple. This earnings per share of $11.89 right here, that is the earnings per share historic. We are expecting this to grow. We are expecting to earn more. At least we are expecting to earn 6.25%. Now, based on this, we are willing to pay $190.15 today. If we believe that there are issues that would make it so that Apple can earn more and therefore make us more money, then we would be willing to pay more for this stock. Now, let's assume that net income does not change, $11.89, and the current price is $200. So just as a confirmation, by the way, let's replicate this. $11.89 is net income divided by our current investment of 190, and that gives you the 6.25%. Now, we've simply gotten this PE from Yahoo Finance, which is calculated as the price over earnings per share. We simply reverted that, which gave us 6.25%. However, all we really are doing is very much like the bonds. How much are we making over how much are we investing? So we are going to earn, or we earned in Apple $11.89, which means based on what we're paying today, 190.15, we are earning 6.25%. Now, based on that, if we start paying more for this and we earn the same of $11.89, then we are going to earn less, $5.95. Notice, very much like bonds, if we pay $2.30 and earnings per share does not change, then we end up earning 5.17%. Let's say we pay $300 for the same $11.89, then we're going to be earning almost 4%, significantly less than $6.25. Now notice, as we pay more, our return, our net yield goes down. So let's say that for whatever reason, price goes down to 140. Now, $11.89, let's assume, does not change. And with that, we end up making 8.49%. Now, again, notice, what we're paying today determines what we're earning in the future based on a net income. Now, just like we talked about it last week, the net income on a bond is known. There's some risks involved, obviously, and based on that risk, we would pay more, we would pay less, and we would determine the yield on that bond. By paying more, you earn a less return. By paying less, you increase the return. Now, obviously, if you wanted to buy that bond for $10, you probably wouldn't be able to. $50, you probably wouldn't be able to. There is some competition out there for that investment. There are other investors who are willing to pay perhaps more than you or less than you. And based on that competition, the price of the bond is determined. And therefore, that price determines the yield. Very much like that for the stocks. There are other people who believe that the net income for Apple might go up or down. And based on that expectation, people are willing to pay more or less for a stock. Now, by paying more, they lower their yield. By paying less, they increase their yield. So if we have an expectation that interest rates are going to go up, meaning if the alternative cost of investment is going to go up, what should we do with respect to our stocks? So let's take a look. If you look at the daily curve at 2.41, so as of today, it's 2.31 month, and then somewhere around 2% for a year. Now, which means I don't have to take any risk if I were to take or purchase a US Treasury. Zero risk. And based on that zero risk, I can still earn 2% a year. Now, I'm not even going to talk about inflation or any other detrimental value on our investment. However, if we invest 1 year, we're going to make approximately 2% without taking any risk. Now, if we invest in an Argentinian bond, right there, for about a year, maybe a little bit more, then we're going to be earning 7.8%. So why should they, the Argentinian government, sell this bond so cheap? Because there are no buyers at a price that's higher than this. So it is not up to the Argentinian government to decide what interest rate they are going to charge or they are going to pay. It is up to the market to determine how much yield they're going to earn by paying more or less for this specific bond. Now, the Argentinian government can decide to sell or not sell. The price may be too low, so they may walk away. They may not issue. If they really need the money, then they might actually issue at whatever price that they can get, or the most competitive price. At this time, market determines the price to be $90.37. Based on that price, based on all the investors willing to buy and sell and trade at that price, the yield turns out to be 7.8%. Notice, for the treasuries, it's about 2%. So why is it that the Argentinian risk is so high? Perhaps Argentina has a default risk, a risk that they may not pay. However, based on that expectation, we are discounting this bond and paying $90 and ultimately earning 7.8%. Now, going back to the stock. Now, Apple right now is trading at 6.25%. That's actually closer to the Argentinian risk than the US Treasury. I mean, if you look at the Apple stock, I'm not so certain if it is as bad as Argentina, risk-wise. I'm also not so certain that if it is as safe as the US government. However, the market is right now pricing it at $190. And based on that current price, the net yield right now is about 6.25%. Now, there are trade war issues. There are Huawei issues. And based on that, Apple is expected to be influenced by this international political and economic conflicts. If they hit Apple, we might actually lose a lot of money. They might actually lose a lot of money. Based on that expectation, they will simply, or the market will simply discount the price, therefore to reduce the stock price and therefore increase the net yield. So we'll talk about what determines those expectations, or how the price is determined based on the expectations of market, on the second part of this lecture. So thank you.